For more on the markets, we want to bring in our next guest, Alicia Levine, BNY's Wealth Head of Investment Strategy. And Alicia, how are you looking at things differently this week, or even at the end of this month versus the beginning of this month?
Well, it's been a really long month, Becky,
Yeah,
as you know, for all of us in this business, very long. I'd say, look, the market's up 15% from the low that Monday morning, which is remarkable. And I'd say...
Which Monday morning? The Monday morning
after Liberation Day.
Yeah.
And I'd say in many ways, I'd say the market is treating the tariffs and the impact of tariffs as a typical market downturn that you can recover from rather than some existential threat that we've heard about for the dollar and in the bond market. But the S&P has done what the S&P does, which is, you know, when it's down 20%, more, we hit down 19.5% from the high, you tend to move higher. This was very quick. But when the VIX is over 40 or 45, if you close your eyes and buy, it tends to be a good time to buy.
Is that because the market thinks that there are trade deals that are coming and a lot of these tariffs will either go away or come down? Or is that because the market thinks we can absorb it, whatever happens?
So I think, you know, our feeling on this 3-4 weeks ago is that the only way the market stabilizes is with some kind of policy response, either from the White House or from the Fed. And the Fed has told markets it's not in the game right now. It's watching inflation.
Yeah, so that look at us, basically.
Right. So basically that left the White House. And we did see a policy response. You know, 6 days later, we had the 90-day reprieve, you know, and then we started seeing lower tariffs on autos and conversations about deals were almost done. And essentially that was, in a sense, part of the policy response, removing the worst case scenario, which allowed the market to really move the risk profile.
You think the market really thinks about what's doing? If you ask a technical analyst,
right,
they say we don't even care.
Yeah, but look at the bounce yesterday.
I know, but the S&P does bottom when things
I think
when things look bleakest, and I'm just wondering whether it really thinks about it or whether it just does it and we try to...
It prices it in. I mean, in this particular case, it priced in the worst case scenario in about 2 weeks, or maybe even 2 days. I mean, when you have the VIX at 57, that's pretty much the worst. The last time you ever saw a read like that at all was in 2020, and then before that, it was 2008.
In hindsight, looking at what you think would cause individual players, which make up what happens, that it wasn't the Fed that they were relying on. It's that there will be some type of...
There'll be some sort of policy response that takes away the worst case scenario.
That's not for sure.
It's not for sure.
No.
It's not for sure. I'd say this, you know, when I look at markets and where we go from here, I think we're in a range. I think the low on the range is where we hit about 4,800 because the market is not pricing in any kind of financial crisis or a credit event yet. And we're going to hit resistance at about 5,600 here. So we're here, right? We're here. But I think the issue of it can always get worse in the real economy, which, yes, and we do expect it to get worse. The issue is that's all out there. You know, the empty container ships from China, the empty shelves
that's factored in
this summer, all of it. You know, the international travelers paring back their traveling to the U.S., we know about this. The market knows this. And so the market bottoms on bad news.
That's what I told the Wells Fargo guy yesterday. He kept saying, well, and I go, what do you mean? When this happens, the market's going to go down. And
the market's forward-looking. Right?
Okay, I think the market undercuts the 48.35 low if there's some sort of financial contagion there, right? So right now...
a recession wouldn't do it.
I don't think a recession would do it now because we've all expecting a recession. Every economist, every Wall Street analyst is looking at this and saying it's very likely we're hitting an air pocket. June, July, August, this is where we're going to see...
That's the new base case.
That's the new base case. And so the market's already risen from that, knowing that. And so it has to be some new exogenous shock as yet unknown. When I look at the financial sector, if you go back to February 19th and you look forward the next 2 months, the financial sector is actually outperforming the S&P, which tells you the market's not pricing in a financial contagion or any kind of real credit crisis. And so I'm comfortable where we are. I do think we're at the top of the range. I don't want to sound like we're going back to where we started the year. We actually could by the end of the year if this thing gets wrapped up over the summer and then the market starts putting just a higher multiple.
Which part gets wrapped up over the summer?
You know, if the tariff issue gets wrapped up by the summer. I think at some point, clearly there's a put in the White House about what happens with the bond market and with the U.S. dollar. And the speed of that, I think, was probably unnerving.
The extension of the tax cuts, that is the base case scenario that people are looking at, too?
That's also the base
a
case. And you know, most of the extension of the tax cuts is not going to be stimulative to the economy because it is just a continuation of policy. I think the deregulatory side will be better for growth. So we're talking about deregulation. And actually, Secretary Bessent talked about this at Economic Club of New York a couple of months ago, deregulation in the financial sector. He really focused on that, but also energy, also manufacturing, also construction. I mean, that'll get things moving. The part of the tax bill that could be growth positive would be the immediate expensing of investment and the immediate expensing of manufacturing costs. That would be additive. But I think ultimately this giant tax bill is just going to be kind of neutral to growth.
So you're telling people to do what? If you think we're priced fairly, but at the high end of fairly, do you hold out here? Do you have to see more before you buy it? The market's forward-looking. How do you get to that point?
So look,
if you assume at the end of the year you could be back at high levels.
We don't trade client portfolios. We have long-term investors. Our clients have all been diversified, which means they took advantage of international outperforming earlier this year. So our portfolios were just not as down as much as NASDAQ or the S&P. But I think it's fair to say that, you know, we need something else at this point. I think the resistance is real at that 50 and 200 day. We've talked about that it's likely not to be a V-shaped recovery simply because the Fed is not coming in. You get those V-shaped recoveries when the Fed steps in, and they've told us they're on the sideline. But it's a comfortable range. You know, the talk of 4,000, I think, is probably not what's going to happen here. Again, unless there's some sort of financial crisis or contagion happening.